Hey, good morning. This is Mayor Valensky with Driving Markets. Okay, so I just want to give a bit of a macroeconomic picture regarding the labour shortage globally. Let's just go into a bit more detail. What is causing this labour shortage? It's not the expansion of the global economies. They haven't shot up so much where there is so much demand for labour and therefore everyone is just asking for more and more workers. What's actually caused this labour shortage? The main cause, or the starting cause, was COVID-19, the Chinese flu, corona. If you notice, Chinese flu is not used anymore because it became diplomatically incorrect to call it the Chinese flu. But I'm not diplomatic, so it's the Chinese flu, COVID-19, call whatever you may. That caused a lot of shortages in the labour market, and also caused a continuing of long-term illness. So I just had to think about that for a second. The long-term effects of those people affected by COVID-19 is still impacting the labour market today. So the long-term illnesses that those people have suffered, or the change in lifestyle where workers have decided not to go back to work, or have decided to continue working from home, or change jobs, or look at their life and say, where do they want to spend their valuable time? That has caused a contraction in the global labour market in the West, whether it's the UK, which is short of around about 500,000 workers, in Europe, or in the US. Now, if we take UK specifically, what's happened in the UK is you've had a double impact of COVID-19 and the Brexit. And the Brexit invalidated all of the work visas of those people that were in the UK, and those visas have not been renewed. And there was a migration from the UK over back to the home countries where those people came from, whether it's Poland, whether it's France, Italy, Germany. And now the visa process is a little bit elongated, and therefore that is stopping the importing or the migration of workers from Europe over to the UK, and therefore you've got a shortage of 500,000 workers based on long-term illnesses from COVID-19, visas, exit, Brexit, and a change in lifestyle of the workers that were working in the UK have changed, and therefore there's a big shortage. So the cost of labour is going up. The price of that labour is increasing, and that will have an impact in the UK, in Europe, and in the US. Only the UK has the effect of the visas because of Brexit, but the other countries still have the long-term health issues that labourers or people are suffering as a result of COVID-19. So that's why there is a labour shortage. Moving on to a couple of other points. Today you've got the Bank of Canada coming out with its rate report, or rate rises. Now there's going to be guaranteed 50 basis points rise in the interest rates in Canada. However, there is an outside shot, an outside call that maybe might move by 75 basis points. The CAD, the Canadian dollar, is only going to get stronger over the coming months and over the year, mainly basically because of interest rates, and also because that Canada is a massive mineral producer. They're one of the biggest producers of iron ore, palladium, nickel, gold, diamonds, gemstones. And remember, they are selling their goods in Canadian dollars, and they're priced in US dollars. So the overseas dealers have to pay the Canadian dollars to Canada in order to buy those goods, or at least the producers need to be paid in Canadian dollars, and that's going to push up the value of the Canadian dollar. So it's interesting one to watch in this afternoon's market. What will happen to the Canadian dollar, and what will happen to Canadian interest rates? I see Canadian interest rates long term going higher. They are part of the G7, so you're going to have an impact overall on the forex markets. Yesterday the markets came down slightly, not much, purely on the back of more inflation fears and more interest rate fears. Bitcoin interest rate interestingly settled at around about the $31,500 mark, and that is just above bear territory. But I do expect Bitcoin to go down because overall the atmosphere in the global markets on risk is not there, And Bitcoin, as I said many times, is a risk asset. So you're probably going to see Bitcoin float down to $20,000. I've been questioned, why do I think that? Because it is a high risk asset. Also, all those investors that invested last year in the Nasdaq or in high growth stocks are nursing losses anywhere between 50 and 80%. So if you bought those stocks outright, then you're just going to have to hold on for the next 20 years for them to catch up. Or if you bought it on a CFD, which is a leverage product, then you might want to take your losses and just look elsewhere for another opportunity. Oil is on the way up. Oil is going to breach the 120 level again very, very soon, because the EU is now putting further sanctions on Russia. The war in Russia and Ukraine is not going to end. Russia's going to stay in Ukraine. They're not going to withdraw from Ukraine, and Ukraine is about to go bankrupt. That's what's likely to happen as a result of Russia's invasion, and the EU will have to support Ukraine with tens of billions. Thank God the UK is out of Europe. Have a good day. Driving Markets. Catch me on Instagram, YouTube, WhatsApp, LinkedIn, Twitter, etc., etc. Have a good day.